All right, but we move on, and the key metric for returns display has been set. The Association of Mutual Fund in India, AMFI, has released new guidelines to use only 10-year compounded annual rolling returns to ensure transparency in mutual fund advertisements. Going in the backdrop of this, SEBI had noted malpractices such as illustration advertisements that could mislead investors into believing fixed return in market investments, which included fixed returns for their investments from SIP and SWP. Now, AMFI has issued a best practice guideline circular aimed at providing conceptual clarity to investors in non-scheme related promotional materials. Let's discuss more on this. I have with me Harshvardhan Rungta, CFP CEO, Rungta Securities. Harsh, good evening and welcome to the show. So SEBI had highlighted this, and now SEBI had asked AMFI to ensure that all the mutual fund houses actually implement as per these guidelines. So I really want to understand the kind of return range that's been proposed for different category of funds. What is that range, and how can you also, in spite of having these kind of range in your illustrations, cannot even promise that these are guaranteed returns? I think this is something that's also been under focus.
Yes, Kavita, absolutely right. So the underlying fact remains, and irrespective of what guidelines come out, all investors must understand and keep this in mind. There are no guaranteed returns whatsoever in any mutual fund schemes. So if be it debt, be it target maturity funds, be it equities, be it hybrid, there is no guaranteed return whatsoever. If anybody has been telling you that it's a target maturity fund, so whatever investments they're doing, you're going to hold on to those papers and you're definitely going to get that return, even that is wrong. So these are only, indicative kind of an illustrative purposes that a person can probably, an investor could probably look at them. Now, what is this whole issue about? Now, there are certain products which combine an SIP over a period of, say, probably 10, 20 years, and thereafter talk about SWP, a systematic withdrawal plan, which is a multiple of the SIP that you make. Say, for example, there is an illustration given to you that you invest 10,000 rupees every month, and after probably 10 or 15 or 20 years, you can withdraw 40 or 50,000 every month. So this kind of projects to the investor that this is more or less a guaranteed return. It's like saying that I'm putting 10,000 now and I'm eligible to remove 50,000, which I will get in the form of guarantee. However, the underlying calculations have certain assumptions. Now, what SEBI has tried to do in the circular in March 2023 has said that you cannot combine a product like this and give an impression to the investor that it is guaranteed. Now, the same thing in the best practices guidelines that AMFI has come out with has standardized what illustrations you will use. So, which is a good habit, a good practice, wherein you will be looking at, giving an illustrative returns, which is going to be standard across, for which they have taken a 10-year rolling return. So, as a benchmark. So, if you're investing into equities, an illustration needs to be given to an investor to understand the power of compounding. An illustrative return will be indicated. Say, for example, it will be in the range of 12% to 13%. Say, for example, the Sensex that the circular says that a 10-year rolling return is 12.64 and the Nifty is 12.93. Now, if you're going into the hybrid categories, which have equity of 75% allocations, then again, they are very clearly specified that if you're using the Sensex, that will be 11.28 and Nifty 11.50. So, all in all, you're also seeing all the illustrative rates as in the AMFI circular flash on the screen as well. So all the categories have been standardized. So very clearly an investor will know exactly what they are looking at, and that is based on the 10-year rolling return. And though again to specify, this is just for illustrative purposes. Whatever happened in the past, if there is a 12.93% illustrative return, does not mean that is going to happen in the future as well. But just that it can be an indicative assumption for an investor to understand how the power of compounding will work.
All right, I think Harsh, you've explained it all in just one question, and quickly I think it's time for me to move on to our query section as well, because we have our viewers waiting for their answers. Let's take Kunal's question from Mumbai first, and he wants you to review his mutual fund portfolio and the schemes that he has. Okay, so he says that the goal is wealth creation, at least 1 crore in 10 years. ICICI Blue Chip, Mirae Asset Emerging Blue Chip. He has Access Mid Cap, Mirae Asset Mid Cap, Nippon Small Cap, SBI Small Cap, Quant ESG, SBI Banking and Finance. HDFC Defence Fund, DSP Banking and PSU Debt. Okay, so a lot of exposure in mid and small cap. So what should be out of his portfolio?
Kavita, what I'm actually worried about is the fact that there are 9 schemes that he's investing into, and the total SIP that he's doing per month is only 10,000 rupees. So very clearly, Kunal, I mean, it's good that you're looking to diversify, but if you have 10 schemes or 9 schemes, it doesn't really serve the purpose of diversification. It's only going to lead to duplication and multiple and administrative burden on yourself. I can just consolidate your entire portfolio in the following 4 schemes, and I've retained the schemes that you already have in your portfolio. So I'm not adding on to anything new, just the values need to change. So you retain your ICICI Pru Blue Chip, in which now you will invest 3,000 instead of 1,000. Mirai Asset Mid Cap 3,000. Nippon India Small Cap 3,000. So you have an exposure into large, mid, and small cap, all categories, equal allocation. And amongst the thematic and the sector funds that you have, just retain any one. Either you could keep the SBI Banking and Financial, keep the Quant, ESG, HDFC Defense. These 3 you have, just retain any one, whichever you like, and that you put 1,000 rupees. All other schemes you may redeem out of that, and then just consolidate amongst these 4 schemes in the same proportion. I think that's good enough. And finally, with regards to your accumulated corpus that you're assuming, even if I take a 12% kind of a return, which is now that we discussed as per the AMFI circular, you should expect about a 23 lakhs after 10 years, certainly not about a crore that you're looking at.
Harsh, we'll move on to our next question, which is from Rajiv Sharma. He says that he wants to invest in mutual funds for at least another 5 years to create a corpus for his son's future education in US, and he wants to know as to what kind of investment strategy he can opt for.
Oh yeah, so this is for his child's education overseas. So it will be very helpful if he has an hedge against the dollar appreciation also. So for example, I'll advise him to keep a mix of Indian equities and international equities. So he could do it through an aggressive hybrid funds in the Indian space, in the Indian mutual fund space, and in the US allocation, he could do it either through an index fund, which I will just tell them. So now look at, if he's investing through lump sum, then of course he should go in for a balanced advantage fund. And in case he's investing through SIPs, then an aggressive hybrid fund will be good for the Indian portion that I'm advising. Now, the ICICI Pru Balanced Advantage Fund would be a good option if he wants to invest in the Indian equities as lump sum. If he's going through SIP, then a Mirai Asset Hybrid Equity Fund, which is an aggressive hybrid fund. The equity allocation will be with a minimum of 65%. In the international portion, because to take a USD exposure, so take a dollar exposure because he's going to spend in dollars in future, it will be wise to at least have some exposure in dollars. So at least he has the hedge against the currency risk that he will eventually run. So 2 options again I can give. If he wishes to spread the money across the globe, so HDFC Developed World Indexes Fund, which invests into US, Europe, Canada, Japan, and Asia Pacific ex-Japan. Or a Motilal Oswal Nasdaq 100, which focuses only on the Nasdaq listed 100 companies.
All right, we have more queries, but then today on this show, Harsh, that's all the time we have. Thank you so much for being on the show and helping our viewers with their financial portfolio queries. And with that, it's a wrap on the Money Show also. But I'm going to leave you with our WhatsApp number and email ID where we keep waiting for your queries. You can send us your questions on our WhatsApp number, which is 865-797-4571. You can also email us your questions on the Money Show at etnow.tv. So that's all from me today. See you next week. Goodbye.